your student loan payments or loan balances a major obstacle in your financial life? Then tune in and let's escape student loan debt. Hello, my name is Brenton Harrison. I am the creator and founder of Escape Student Loan Debt and your host for the Escape Student Loan Debt podcast. I want to thank you guys and welcome you to episode 2. We appreciate you tuning in. When I was thinking of what I wanted to do for the first substantive episode of this podcast, where we actually get into the pros and cons and how student loans work, I thought it would be wise to go through a history of student loans in the first place, how they were created, how they came to be, because I am a big believer that if you have an understanding of from whence you came, it can be instructive as to some things that are coming ahead in the future. So let's go to the first date in the history of student loans, 1944.
You're listening to the Escape Student Loan Debt podcast.
Subscribe now at escapestudentloandebt.com.
Welcome back.
1944 is an important year in the history of student loans because this is the year that the GI Bill was signed into law. This was a bill that was designed to reward returning veterans, many of them returning from service in World War II, for that service by basically giving them all of the money that they would need to cover tuition at a school of their choice. So if we talk about layers between funding source and end user, there were no layers when the GI Bill was introduced. The government was giving money directly to students at the rate of $500 per year to cover tuition. So that is the action. What was the reaction? One of the first things that you saw when the GI Bill was introduced was that everyone didn't get to benefit from it. You had Black returning veterans who wanted to use the GI Bill for their schooling, but they couldn't because even though they received $500 per year for tuition, they still had to be accepted by that school of their choice, and many of them were not because of the color of their skin, not the content of their character. And you also had women who were veterans who wanted to use the GI Bill who were unable to, not because of the color of their skin, but because their military unit was marked as civilian duty, and civilian duty units were not eligible for the GI Bill. The next year in student loan history takes us to 1958. 1958 sees the creation of what's called the National Defense Student Loan Program, which would later be known as the Perkins Loan Program. And this is the first instance where you see a layer between the funding source and the end user, because with the creation of this program, the government would give money to colleges and the college would be in control of dispersing the money to students at a rate of $1,000 per year. So that's the action. But the reaction was that the need greatly outpaced the funding of this program. And this is where you start to see the Treasury Department really see that the amount of money that they have going out towards college is more than they expected. So the Treasury starts looking for ways to conceal the amount of money that they are spending towards student debt. And that started in 1958 with the creation of this National Defense Student Loan Program. Next in student loan history, we have the year 1960. And in 1960, you see the creation of a fund called the United Student Aid Fund. The way it started was in 1960 when they created this fund. A number of wealthy entities and wealthy donors created this fund as a way to incentivize banks to offer private student loans by saying that if you give these loans to these students and these students happen to default on that loan, we will reimburse you for 100% of what you would have been paid based on the amount that you gave them in the form of the loan and the interest that you would have received on that loan. If you look at this from the bank's perspective, they now have next to no risk in lending this money to the student. They know that either the student will pay them back, and if the student doesn't pay them back, they can simply go to the USA Fund and ask for those defaulted loans to be reimbursed in full. Now, that was the action, but what was the reaction? Just like in the 60s where you saw redlining, the process of a bank either turning down completely or turning down a family from a certain neighborhood when they were trying to get a mortgage loan if they were a Black and brown family. You saw the same thing happen when it comes to these USA Fund-backed private student loans, because after going through income testing and financial testing, which was a requirement of these student loans, they would often turn down female, Black and brown, and even poor white students who were hoping to get these student loans for their schooling. So with the GI Bill, you saw money go directly from the government to students. With the creation of the National Defense Student Loan Program, you saw money go from the government to colleges to students. In 1960, with the United Student Aid Fund, you see money go from the USA Fund to banks to students. And after the break, we'll tell you about another insertion in terms of the number of people and the number of entities involved in this exchange. Because after the break, you're going to see the government partner with the USA Fund to blend in terms of the cost and funding of education, government funding, and private entities.
This is the Escape Student Loan Debt Podcast,
A show for established professionals whose student loan payments or loan balances are impacting their marriage, their business, their credit, or their dream of achieving home ownership.
We'll be right back.
Are you interested in learning the tools and techniques we use to get student loans forgiven, reduced, reorganized, or expedited? Well, great news. We're currently updating our flagship course, Escape Student Loan Debt, to reflect the current changes in the student loan landscape. To stay up to date on the launch of the course and opportunities to sit in on our live recording sessions, head to escapestudentloandebt.com and join our email list now.
You're listening to the Escape Student Loan Debt Podcast.
Subscribe now at escapestudentloandebt.com.
Welcome back.
Let's get back to our student loan journey, and we are now at the year 1965, which sees the creation and the passage of the Higher Education Act. And the Higher Education Act introduced something called the Guaranteed Student Loan Program. And through that loan program, you started to see loans that would later be called Stafford loans or FEL loans. And if you are a borrower of a certain age, which I would characterize as my age or older, Stafford loans and FFEL loans were probably your first introduction to federal student loans. Now, the way that this Higher Education Act and this Guaranteed Student Loan Program worked is that it was a funding source. It was backed in support for the United Student Aid Fund. Here's how this journey would happen. If I default as a student on my student loan, then the lender, the private lender who gave me that loan, is going to go to the United Student Aid Fund. The United Student Aid Fund is going to guarantee that 100% of the principal and interest is given to that bank in the event of my default. But then the United Student Aid Fund goes to the government, and the government reimburses the United Student Aid Fund for 80% of the losses that they took on that loan based on current interest rates. And if you're following along, the consequence of this is that a private lender who's giving a federally backed student loan now has a 0% chance of taking a loss on this loan, because either you're going to pay them back with principal and interest, or if you don't, they can go to the USA Fund for support, and the USA Fund can go to the government to get 80% of their losses reimbursed. All of these entities are being introduced into the equation, also the Treasury Department, rather than giving money to the student directly and showing how much is going towards education, can conceal those costs as they try to pass a balanced budget. And in our last stop for this episode on the history of student loan journey, we're not going to cover a particular year. We're going to cover a particular period in time. And that period in time is 1968 to 1971, because this saw a series of shifts in the marketplace and in this interchange between private entity and federal government. And it all started with the process of how a loan works in the first place. When you have a bank that offers a loan to an end user, a consumer, they don't have that money in their storehouse and then just give it to you as a loan. In many cases, they actually go to another entity and they borrow money from that entity and turn around and give it to you as a loan at a higher interest rate. An example would be they might borrow money at 4% and then turn around and give you that same money at a 7% interest rate. So in actuality, they're only getting a 3% spread on that loan. What happened when you had the Guaranteed Student Loan Program, where the government back end supported the USA Fund, which gave back end support to a bank and encouraged that bank to lend money, is they did agree to reimburse them for either all or a significant portion of their losses, but they only did it based on the current 6% interest rate that the bank was charging to consumers at that time. During the years 1968 to 1971, the interest rates rose in terms of what it cost a bank to go get the money to then turn around and loan to the consumer. So when you have this scenario, they are really faced with one of two options. The first option is that they can pass on those increased costs to the consumer. Option two is to pull out of the student loan market in its entirety. Now, if you're Congress, the alternative to a private lender giving a federally backed student loan to the student is for you as Congress to give that loan directly to the student, which messes up the whole plan of being able to conceal exactly how much is going towards education. So what they did instead was they incentivized these lenders to continue giving student loans and stay in the marketplace. And how they did it was they guaranteed them a certain interest rate return above and beyond what the student was actually paying. As an example, they would tell that lender, charge the student 7%, and we will give you an additional 3% interest rate return on every single student loan rather than just giving this money directly to the students. These are the types of things where you start to see the exchange between private entity and federal government costing the student extra interest in a way that's being passed on to them, not just as the borrower, but also as the taxpayer that's providing the funding for these federal programs in the first place. So this is the first step in the history of the student loan journey. We brought you up to 1971. In the next part 2 of the history of student loan journey, we're going to talk about the creation of our favorite entity when it comes to federal student loans, Sally Mae. I'll see you then.